Hi, welcome to Neppy Invest. So goodbye 2020. Some people might say good riddance, but I actually think it's been a really fascinating year, not only on the stock market, but also in our personal lives to see how different countries have reacted differently to the pandemic. And hopefully we can get the pandemic under control in 2021. And hopefully by the end of 2021, we can look back at what's happened in 2020 and we can learn from the experience moving forward. So what I'm going to do with a series of videos is looking at some stocks I'll be watching and some stocks I think everyone should be watching for 2021. So a lot of these companies, even though I'll be watching, I definitely won't buy into some of these companies. So a little bit of a different track I'll be taking in my videos moving forward. So I've broken down into themes. And the first theme I'll be looking at is the contrarian play. So the contrarian play is going against the herd. So looking at sectors and companies within sectors that are beaten down, not loved, that sort of thing. And it's been shown in the past that companies that have underperformed one year tend to outperform the following year or following years. So I'll definitely be looking at that sort of play in the first part of 2021. So before I get into those sectors and companies I'll be looking at, I'm just going to do a very brief review of 2020. So this is just looking at XJO, the ASX 200 companies. When we started the year in January, February, it was getting a little toppish, a little expensive, the stock markets. In fact, I started to pare back my investments in late January, early February. And I started to pare back on two things. The stock markets were looking expensive. And when I was doing my research on the effects of COVID-19 in China, I was getting some, I won't say there were some troubling things that I was seeing what was happening in China. And if I thought the virus was going to get out into the world, that we're going to see some troubling times throughout the whole world. And that sort of played out in the end. I did not expect the crash to be so significant in late February to March. It was like a 1 month crash. So I did not expect that crash to be so violent. And I was looking at buying back in between the prices of 4,400 and 4,000, but I expected that to be over many, many months. So I expected to be out of the market, for like 4 to 6 months. But then the recovery happened very quickly. I started buying back in late March, early February, but you can see here the recovery has been much more slower than the crash. And that shows you, or it should be proof to you, that fear is a much more powerful emotive than greed. And usually crashes are much more violent, much more quick than recoveries. Now, if I was looking at this chart as an individual company, I'd be very bullish about the 2021 outlook because we've turned into an uptrend here. The market is in an uptrend. And when the market's in an uptrend, that uptrend can continue for quite a while. So in isolation, I would think that 2021 is looking bullish. But, there's always a but here, I'm very wary because a lot of experts are thinking along the same lines as me. In fact, I've seen some analysis, some experts are saying they're expecting a 20 to 25% uplift in the stock markets during 2021. Roger Montgomery put out a bullish outlook recently. And usually if everyone's in agreement, that contrarian thoughts start to percolate in my mind, because I very much look at the contrarian play, which is the theme of this video. So even though I'm bullish, I always, in the back of my mind, just thinking if everyone's in agreement, there is that potential, that contrarian play, that instead of stock market moving forward overall in 2021, it might move back. So that should be in everyone's mind, back of their mind. And so the overall theme of this video is the contrarian play. So these are the sectors I'll be looking at. So I'll be looking at individual companies within these sectors. So the first one is coal. Now, I think the long-term outlook for coal is quite bearish. But just because the long-term outlook for coal could be bearish doesn't mean the short-term outlook or even the medium-term outlook is bearish also. You actually could see very bullish short-term outlooks in coal. And we've seen the share price or the price of coal itself get down to all-time lows or nearly all-time lows or 10-year lows anyway. And we saw this about 4 or 5 years ago, where the share price of coal companies just went through the roof because the price of coal recovered, even though the long-term outlook for coal was quite bearish. I think a lot of people, a lot of sectors are very bearish about coal, except maybe the Australian government or even the state governments, because they keep approving coal mines. But I think what's happening also in China, they're blocking our coal boats from entering ports. I think that's a short-term issue. And we're seeing some of the companies' share prices begin the first signs of the beginning of an uptrend. So I'll show you a company that's in the coal sector. REITs, so this is real estate plays. I'll show you a company that is in that sector. Travel and leisure, or leisure if you're an American, those two sectors can be lumped together because they've been really hard hit by COVID-19. And if the vaccine, comes into play, if we start to see traveling become more common throughout 2021, we could see a lot of these travel and leisure companies recover quite quickly. And the last thing I'll be looking at is a company that's completely hated. It's quite a few of these companies on the ASX, AMP, Slater and Gordon. They've gone through some really bad times. Management have been awful. And one of these companies I'll be looking at today, and I'll get into that in a second. Now, the next slide is a slight change in track to how I'm going to do my videos. So what I've done in the past is giving you some ideas, right? But a lot of those ideas is because I'm interested in these companies. So what I'm going to do now is give you ideas in companies that I might not be interested in. Just because I might not be interested in a company doesn't mean you don't have to be interested, because we all have different investing philosophies. Well, I hope we do. So just because I might not be interested in these companies doesn't mean you might not be interested. And I believe that giving you ideas is one of the most powerful things I can give you. And I've found that out over the past few months, that people have taken some ideas, done their research, and they've used that research to buy into companies. So hopefully you can take some ideas away from this video, do some research into these ideas, and maybe make it a decision based off that idea and that research. So the whole point of this video is to give you ideas. So the first company I'll be looking at is Stanmore Coal. So I've talked about Yancoal, New Hope, Whitehaven in some previous videos. Those are the big coal companies in Australia. So I've gone to the next tier down. This is a coal producer. They do export their coal, Stanmore Coal. So market cap of 215, so quite low. 365 of revenue and operating cash flow 6.4. So they are operating cash flow, even though the coal prices are quite low. So you would expect if the coal price starts to go up again, Stanmore Coal will be a beneficiary of that. And we've just started to see in the last month or so, the share price start to turn up. You can just see that the moving averages are below the share price. That's a good sign. And if the share price gets to around 85 cents, that would be very bullish in the long term. There was a potential acquisition of Stanmore Coal about 6 or 7 months ago, which I must have fallen through. So I remember the share price went up to like $1.10 based off that acquisition. Someone wanted to buy out Stanmore Coal, so that must have fallen through. And we did see the share price go to low as 50 cents in the last few months. So last month in particular, we've seen a potential turnaround. So my investing philosophy is a little bit different than my personal philosophy, especially when it comes to something like coal. So when I think of coal in my personal philosophy, I don't understand why the governments are approving coal mines. The future of coal is looking very bleak. But when I look at coal in my investing horizons, I think there is that short-term potential, even a medium-term potential for a good uplift in the share price in coal companies over the next 6 months or so. So I'm not reticent to buying into coal companies at all. Now, REITs. So this is Dexus. So there was a lot of potential companies I could have looked at. Goodman Group, Centre, Stockland, that sort of companies. I decided to just focus on Dexus because they do have a lot of office company or office, we'll say, property they've invested in. And the share price too hasn't really rebounded as much as some of those other companies. In fact, I think Goodman Group share price right now is higher than it was pre-COVID levels. And if you look at the past month in the share price, it's starting to turn around. In fact, if the share price gets above $10 on a long-term basis, or not more than one day, so numerous days above $10, it'll be very bullish. So I'm not adverse into buying to Dexus, but they are in the office space in CBDs. So you can see the market cap, they are 10.5 billion, price to book ratio of 0.87, which is quite cheap, which means they do have assets on their books which is higher than the market cap, which is quite interesting. But they do actually have the history of their price to book ratio being lower than 1. But when I looked at one of their presentations, they're actually very bullish about people returning to CBDs en masse. And I'm not so bullish about that. So I'm not going to get into why I'm bullish, but I believe the 300 years of urbanization humanity's been going through might be coming to an end. I believe there is potential we might be going through a counter-urbanization through the next 100 years. Dexus is of the differing opinion. They believe people are going to return to office en masse, CBDs en masse, and I believe that could be too bullish. But if you believe that Dexus is right, that I am wrong, Dexus will be a really good play for you. So here's an idea I'm giving you that I probably won't take, but you might take, especially if you think I'm wrong and Dexus is right. They do mention something I actually do believe, that innovation is driven by people coming together and collaborating together in groups. But I believe you can do that in hubs, in suburban hubs. And it's also, research has also shown the initial stages of innovation is helped by people to come together. But the rest of the innovation cycle, you can do that with not being in groups, if that makes sense. So I think there is potential that Dexus is being a little bit too bullish around the urbanization, people coming back to the CBDs. And if you think I'm wrong, buy into Dexus. It probably is a good play right now. Sydney Airport. I actually did hold Sydney Airport about 7 or 8 years ago because I held Macquarie Group. And Macquarie Group, I forget the story, Macquarie Group did own a lot of Sydney's airport. Then they sold out and they gave Sydney Airport shares to shareholders of Macquarie Group. And that's how I became a Sydney Airport shareholder, even though I didn't actually buy Sydney Airport shares. Then I sold out, and I shouldn't have sold out because they went through a tear. So Sydney Airport, a couple of interesting things here. It looks like the share price, if you look at this chart, 6-month chart, it's turning around. That's actually quite bullish. And I believe travel will come back to Australia. There's no doubt about that. Sydney Airport isn't a monopoly. They are expanding throughout the world, in fact. But the one thing that I did see when I looked at the 10-year financial performance is they do have negative equity. That's been a thing that's just happened over the past year, which just piqued my mind. I don't know what this negative equity means. It means, well, one of the things it means is they're increasing their debt and they're not really increasing their profits as much as their debt. Anyway, and this is the slide I've looked at. So I've looked at the past, actually not 10 years, it's the past 13 or 14 years, looking at debt and equity. And equity is the blue line. It's been going down and down every year, and the debt's been going up and up every year since 2008. And that's a bit of a concern for me. And they've just done a massive capital raising because of that debt issue. And the massive capital raising will mean that equity actually goes up, it comes down. So that's how they're solving this issue of increasing debt and decreasing equity, is by capital raising. And are they going to keep doing that in the future, which would be a major concern for me if I was a Sydney Airport shareholder. But there are some facts that are for them. They have a really good moat. They are a monopoly. They are expanding. I think they're pretty sure they own Western Sydney Airport. They're even expanding across the rest of the world. They have pricing power, that sort of thing. And I don't think what the issues they've faced in the past year are going to be much of an issue moving forward unless we see more pandemics, which I think is fairly low chance. So Sydney Airport could be a play. I'm even thinking of buying it, but this one little thing of debt moving forward, are they going to increase debt for? Don't like companies who just increase debt willy-nilly anyway. Event, hospitality, and entertainment. So this is within that leisure group. So event, they have those cinemas. I'm not a fan of the cinemas because they just, it costs too much to go. They also have, I believe, hotels, that sort of thing. Now you can see I've put a blue line there at the bottom of the uptrend. So you can see actually it's been 4 low points, and I've just connected those 4 low points. And it's a definite uptrend developing here. In fact, the last low point, or bottom, we could say bottom, was reached a few days ago, just under $9 or so. That would have been a really good price to buy. So this could be an interesting play if you're interested in that that sort of play, that hotel. People are going to go back to hotels, people are going back to cinemas, that sort of thing. But one little thing I'm very wary about is the long-term future of cinemas, because I think it was at Warner Brothers who decided to, instead of putting their movies straight into cinemas, they're going to stream it on one of the platforms. And is that going to be a thing of the future? And this is all for 2021. Every single movie they were expecting to release during 2021, they're going to stream it on one of their platforms. I'm not sure which platform it is, but is that going to impact upon cinemas moving forward? And is that going to impact potentially in their hotels? Probably not hotels, but anyway. So this is a potential play if you're keen in that rebound in tourism, rebound in cinemas, that sort of field, that sort of sector. And the one that everyone hates, retail food groups. So, I mean, there's without doubt, this has been in the stories over the past year or so, how they've treated their franchisees. They've not treated them very well. I don't understand that. I don't understand why you would treat your franchisees bad. You want them to be happy, wouldn't you? It's just like an employer wants their employees to be happy, because an employee happy is more productive. So you'd think a franchisee being happy would be more productive for the overall business. But retail food group didn't see it that way. They decided to milk their franchisees out of money, as much money as they could. And we saw a massive decrease in the share price over a long period of time. And it just looks like over the past few months, the share price could be turning. Now, there was some negative news a few weeks ago or a few days ago, but the share price took a bit of a hit, but then it rebounded quite quickly. So you can just see the share price based off the moving averages is starting to turn. You can see the blue line, which is a 100-day moving average, is now below. It's been below the share price over the past few months. And if I go through to the next slide, this is going back to 2017. The share price has gone from $7 all the way down to like 7 cents. So if you've been a long-term shareholder of RFG, there's little doubt why you hate this company. And you can just follow the blue line here, which is the 100-day moving average. The share price has been below that ever since the top of the trend, which was way back in 2017, early 2017. There's no reason to be holding this stock after that, because it's been in the downtrend and long-term downtrend. So you can just see here why I'm sort of reverting to more of a momentum sentiment portfolio, where I sell out of a company if it goes into a downtrend. And this is a perfect example why you do that, because you would have sold out in early 2017, it's gone into a downtrend, and you're just waiting for it to go back into an uptrend before you buy back in. And you would have saved a lot of money if you did that. And it looks like over the past few months, potentially going back to the uptrend. A lot of risk in this company. You can see market cap 163, still have a lot of revenue, but operating cash flow is negative. So they still have a lot of potential, a lot of risks, a lot of potential of failing. So this would be sort of a very risky turnaround play if you do buy in, and you'd be quick to sell out if it looks like the company is failing. So those are some of the contrarian plays that I'm looking at for 2021. Not only should I be looking at that, you should be looking at too. So those companies I won't be looking at all. If you've got any questions, feel free to leave a comment, especially in regards to some of the ideas I have, which you think could be completely wrong. And again, I'm not a financial advisor. Again, I'm just here to give you ideas, and you can make your own opinion of these ideas. Make your investing strategies based off these ideas. Do your own research. Do never buy in a company just based off what ideas I've given you. Do your own research. And if you do need financial advice, make sure you seek out someone who is accredited, someone who is qualified, and who can speak to your own financial needs. That's all for today's video. Have a good day. Bye.